Hey everyone, and today we are going to talk about two interesting companies that are quietly making big moves in their industries. So the first one is a casting manufacturer. It reported solid Q1 numbers with 11% revenue growth and 57% jump in profits. And the second one is a flexible packaging film player, and it's also firing on all cylinders. The company posted 17% revenue increase and more than doubled its profit. So basically, both the companies are expanding steadily, one through exports and a refined product mix, and the other through scale expansion and tapping into long-term packaging demand. So welcome to another episode of Noisemaker, where we keep things simple and talk about companies that may not always come in the spotlight but have a strong potential for future. I'm Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we'll be talking about two companies that are making solid progress in their business. And if current trends continue, they might continue to grow even further. But before that, let's have a quick look at the disclaimer. So, any discussion, facts, or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So, please conduct your own due diligence before making any investment decision. Now let's move to the first company, Nelcast Ltd, the largest jobbing foundry in India for manufacturing, ductile and grey iron casting. In Q1 FY26, the company delivered strong performance. Revenue rose 11.1% year-on-year, driven by steady volume growth, a favorable monsoon, and strong traction in the tractor and export segments. EBITDA jumped 44.3% year-on-year, with margin expanding to 9.6%. While EBITDA per kilogram improved by 24.4% year-on-year, which was a result of continued cost discipline. Net profit surged 57.2% year-on-year, aided by an improved product mix and better capacity utilization. And what also stood out was the 17% growth in exports, which now contribute 35% of total revenue. And that's despite the ongoing tariff and trade uncertainties. So now Mudit will be joining in for more. So Mudit, how do you see this Q1 performance in the context of Nelcast FY25 numbers, which were largely flat?
That's a great point, Cecil. If we look at FY25, the overall revenue declined marginally by 1.2%, coming in at 1,251.6 crores compared to 1,266.9 crores in FY24. The top line was flat for most of the year, and the net profit fell to 37.3 crores from 54.4 crores, mainly due to weak performance in the first half. But what Q1 FY26 shows is clear turnaround. The company has regained momentum, especially with EBITDA margin improvement and stronger volume-driven growth. And with export demand holding up, this could be the beginning of a better trajectory going forward. Now, Sejal, with exports forming over a third of revenue, do you think this export push is sustainable or just a short-term spike?
Mudit, I actually think it's sustainable. The company is putting in some serious groundwork, and they're also working with 4 European customers who are currently in the final stages of plant approval. And if those go through, and management expects them to be by mid FY27, so we could see a meaningful ramp up in the exports. Also, it's not just volume, it's about value added products. Because Nelcast isn't chasing low margin business, they are aligning the product mix to support better realization and long term profitability. But Mudit, Nelcast is also guiding for a big jump in volumes from 83,600 tons approx to over 1 lakh tons this year. So, do you think that's achievable given the current industry trends?
That's a big jump, but based on what we are seeing, it looks realistic. The demand from tractors and commercial vehicles is stable, and the monsoon has been favorable, which helps the agri-link segment. Also, the company's internal focus on capacity optimization and process improvements should support higher volumes without a proportion increase in costs. And remember, they are not adding new capacity. They are sweating existing assets better, which is efficient. Now, Cecil, what's your take on the company's FY26 margin guidance and their long-term growth outlook?
See, they are aiming for rupees 15 EBITDA per kg in FY26, and based on the Q1, which was 14.7 per kilogram, they're already close, and that gives them room to stay disciplined on cost while pushing up the volumes. So longer term, I like the clarity in their roadmap. They're not trying to be everywhere. It's focused, export, value-added segment, and steady volume growth. And if those plant approvals in Europe kick in, FY27 and 28 could see a solid export-led uptick. So Mudit, what are your final thoughts? Do you see Nelcast quietly evolving into a bigger player in the global casting space?
Absolutely. They have all the ingredients: a strong domestic base, a growing export footprint, focus on high margin products, and a disciplined going strategy. If they stay on course with execution and don't overextend, Nelcast could become a serious player in the global value added castings market over the next few years.
Okay, thank you, Mudit. So now let's move to the second company, which is Nahar Polyfilms Ltd, and they are in the business of manufacturing transparent and metallized flexible packaging films, and they have started FY26 on a very strong note, where their revenue rose by 17.3% year on year, PAT surged around 120% year on year, and EBITDA grew around 88% year on year, pointing to both strong operational execution and healthy market demand. On the back of this momentum, the company has approved a major 450 rupees crore expansion project, which includes setting up of a third BOPP film line of 36,000 MT annual capacity, and this will take the total capacity to 96,000 MT. And the project will be funded through a mix of internal accruals and bank loan. So, Mudit, how do you see this expansion aligning with the demand trends in the packaging industry?
Great question, Cecil. The expansion comes at a very strategic time. Demand for flexible packaging is rising, thanks to factors like growth in e-commerce, higher hygiene awareness, and increased consumption of packaged foods and beverages. What's important is that the Nahar is already running at full capacity, so the addition of a new line isn't just expansion for the sake of it. It's demand-led and positions the company to capture both domestic and export growth opportunities. Plus, with a larger capacity base, they will benefit from economies of scale, which should lead to better margins going forward. But Sejal, looking back at FY26, the base year, how do you interpret their financial turnaround?
See, the turnaround is quite impressive because in FY25, revenue grew 11% year on year, uh, standing at 665.9 crore, up from 599.9 crores in FY24. But the real story is in its margin. EBITDA jumped to 94.1 crores from just 32 crores the previous year, and EBITDA margin improved sharply from 5.3% to 14.1%. Net profit also rose significantly, nearly 8 times jump, which clearly reflects operational efficiency gain and smart cost control. Q1 FY26 just built on this base with a 25.6% sequential jump in revenue. So clearly they have entered FY26 with a strong momentum. Mudit, the company is targeting global BOPP demand projected at $40.5 billion by 2030. So do you think their strategy to go after exports market will pay off?
I think it's a smart and forward looking move. The Asia Pacific region alone is expected to be a huge driver of demand for BOPP films, especially in food packaging. Nahar's existing capacity utilization and consistent quality give it a good entry point into high growth export markets. That said, success in exports will depend on maintaining price competitiveness and ensuring operational reliability on scale. The upcoming third line, once operational, will help meet large global orders and expand their client base internationally. Cecil, what about the domestic opportunity? Are they positioned to benefit from India's internal consumption growth as well?
Absolutely. In fact, the domestic market could be just as critical because India is seeing urbanization, rising disposable income, and booming e-commerce sector, all of which increases the demand for hygienic, durable packaging. And Nahar is clearly aiming to tap into these trends. Their focus isn't just on adding capacity, it's about aligning with long-term consumption patterns both in India and globally. So if they can keep margins stable and efficiently execute the 450 crores expansion, they could transform into one of the leading flexible packaging players in the country. So, Mudit, wrapping up, how do you see Nahar Polyfilms positioning itself over the next 2 to 3 years?
If they say discipline with execution, I think Nahar Polyfilms is entering a high growth phase. They are already proven they can scale margins and profitability. With the new line coming in, they can boost volumes, deepen their export reach, and capture a big share of a domestic packaging boom. All in all, they are building a platform of capacity led margin accretive growth. And that's the kind of setup that could quietly create a strong, solidified business over the next few years.
Okay, thanks a lot, Mudit. That really helped us to understand the direction both these companies are moving in. So now let's take a quick look at how some of our previous picks have performed. So first we have Nova Agritech Limited. We picked this up at 49.5 rupees and it's now at 55.1 rupees, giving a return of 11.3%. GMM Pfaudler Limited from 1271.4 to rupees 1403, and that's a gain of 10.4%. Oriana Power Limited, it moved from rupees 2190 to rupees 2206, delivering a modest 0.7% return. Then Paras Defence and Space Technologies Limited, this one saw a dip from 818.9 rupees to 664.5 rupees, which is a decline of minus 18.9%. Gabriel India Limited, we picked this up at 842 rupees. It's now at 1031, giving a return of 22.4%. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. And here is the QR through which you can access all these previous picks which we covered recently. Now let's move to the summary of today's company which we included in this Noisemaker. So first company is Nelcast Ltd, which reported a strong Q1 FY26 with 11.1% year-on-year revenue growth, PAT rising 57.2% and EBITDA growing 44.3%. Then Nahar Polyfilms Ltd, which delivered strong Q1 FY26 performance with revenue up by 17.3% year-on-year and PAT soaring 120% year-on-year. EBITDA doubled to 18.2 crores with margin recovery driven by operational efficiency. So that's it for today's edition of Noisemaker, and if you found this full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead and stay informed.